Is the US dollar truly facing an unprecedented collapse?
We've gathered insights from leading experts like Dr. Judy Shelton and Lyn Alden to shed light on this critical issue.
And the best part? We're distilling their advice into actionable insights just for you.
Stay tuned to find out how the gold-backed dollar could reshape our financial future.
Welcome to Financial Insights in Minutes, where we simplify the complex.
And don't miss out on our next feature about Paul Tudor Jones's dire warnings on the economy.
In a recent discussion, Paul Tudor Jones provided a stark warning regarding the trajectory of the U.S. economy. He claims that all roads lead to inflation.
Indeed, his perspective highlights a serious issue with the debt doom loop we've been observing.
So what is the crux of Jones's argument?
He argues the U.S. government's spending is spiraling out of control, pushing debt to GDP ratios to alarming levels, which in turn fuels inflation.
That's pretty dire. What's causing this cycle?
It's the unrelenting increase in Treasury issuances that only exacerbates the debt crisis.
Let's look back at the figures. Debt levels are skyrocketing, from a mere $2.7 trillion in 1989 to a staggering $35 trillion now. That's outrageous.
Absolutely. And this debt-to-GDP ratio doesn't reflect well on the future, doesn't it?
What does this mean for interest rates?
Well, if the government keeps spending at this rate, interest rates will inevitably climb, leading to even greater costs.
Can you break down this doom loop he's discussing?
Certainly. As users shy away from buying treasuries, the Fed will have to intervene, triggering more money printing and inflation.
So what solutions are being proposed?
Jones suggests tax increases and reducing spending, but there are doubts about their effectiveness amidst this crisis.
Based on Paul's views, what can we expect moving forward with inflation?
The prediction is significant. Inflation could worsen, maybe even 2 waves of it this decade.
To wrap things up, what's the main takeaway here?
The focus must be on reducing government spending and rethinking fiscal policy to avert greater inflation risk.
Today, we're unpacking the insights of Lyn Alden as she dives into the macroeconomic factors shaping investment strategies for 2025.
Lyn emphasizes that the upcoming debt ceiling and geopolitical tensions could be significant drivers in investment decisions.
What's Lyn's central thesis concerning the macroeconomic outlook?
She believes fiscal deficits and the looming debt ceiling will play larger roles than political changes in shaping the market landscape.
Quite an angle. Could this signal a major shift in how investors approach market risks?
Absolutely. A focus on economic structures could redefine traditional investment hurdles.
The debt ceiling is just around the corner. How might it affect liquidity?
It's pivotal. If drawn down, it could enhance liquidity temporarily, similar to a quantitative easing effect.
Are geopolitical tensions really that impactful for investors?
Definitely. Events like Ukraine and Middle East tensions not only harm economies, but could lead to higher inflation.
So what should investors focus on as we head into 2025?
Lyn suggests looking at liquidity-driven assets, especially Bitcoin and established precious metals.
How do energy prices fit into Lyn's analysis?
Energy is crucial. Significantly stable supplies mean less risk for inflation, ideally.
Fed rate cuts, how are they shaping the market landscape?
They are somewhat impactful, but consumer reliance on existing credit structures complicates the equation.
What does Lyn predict for the 2025 debt ceiling?
She warns it could lead to significant market fluctuations, depending on political negotiations.
Sounds tense. Are there any historical parallels?
Absolutely. Past incidents have often triggered dramatic reactions in the financial markets.
What about Bitcoin? Where's the market headed?
Lyn projects a positive trajectory for Bitcoin, largely due to anticipated liquidity increases.
Interesting. So it seems Bitcoin remains a frontrunner?
Indeed, especially as it correlates tightly with global liquidity trends.
As we wrap up, what's the main takeaway from this discussion?
Investors need a strategic outlook on liquidity and geopolitical dynamics as investment landscapes evolve.
So remaining adaptable is vital for success in 2025.
Exactly. Flexibility and awareness of emerging trends will prove crucial.
Today, we're exploring the troubling signs in the U.S. job market. Seems like hiring is grinding to a halt.
True, it's a stark contrast from the optimistic narrative we've been hearing lately.
So what's the take-home message regarding the recent job market data?
It's clear. The positive spin on job openings doesn't reflect reality. Things are getting worse.
What brought us to this point?
Key factors like layoffs and stagnant hiring are revealing a much softer job market.
Let's dig into the latest job opening statistics. What's the drop really telling us?
It indicates significant weakness. We're seeing the lowest number of available jobs in nearly 2 years.
And what about layoffs? Are they truly on the rise?
Yes, we're witnessing a potential uptick, indicating companies are tightening their belts.
What's happening with hiring rates lately?
They remain weak, reflecting a reluctance to leave existing positions due to uncertainty.
What does the future hold for layoffs in this economically uncertain climate?
We can expect an increase in layoffs as companies adjust to a cooling economy.
To sum up, how should viewers approach their own job security now?
They need to be cautious and prepared for changes as the labor market evolves.
Making the right moves might be crucial in the coming months.
Absolutely. Staying informed and adaptable is essential as we navigate this uncertainty.
In today's episode, we're dissecting Luke Gromen's critical stance on bonds. Buckle up.
Right? He boldly declares that bonds are now deemed uninvestable. That's quite a statement.
What's the crux of Gromen's argument regarding bonds?
He insists that current economic factors render bonds effectively uninvestable, an alarming sentiment.
And what real-world implications does this present to investors?
Investors may need to seek alternatives or rethink their strategies altogether to navigate this environment.
Let's examine how inflation is affecting the bond market.
Sure, rising inflation is a major player here. It's causing yields to plummet and undermining the attractiveness of bonds.
What role do central banks play in this scenario?
The shift in monetary policy tends to create an environment where bonds struggle. Nobody wants to be left holding the bag.
And let's not forget global politics. How does it influence bond viability for Gromen?
Exactly. Heightened geopolitical tensions create unpredictable environments, which makes bonds seem riskier to investors.
What does Gromen predict will happen next for investors?
He foresees a significant shift towards equities and real assets, leaving bonds in the dust.
So commodities and similar investments may rise in popularity.
Absolutely. There's a looming demand for riskier, yet potentially higher-yielding assets.
To wrap things up, what should viewers take away from Gromen's stance?
It's crucial to adapt investment strategies. Bonds may not be the safe haven they once were.
So a pivot towards alternative investments looks inevitable.
Indeed, flexibility in investment choices could prove vital as we move forward.
In today's exploration of America's monetary landscape, we dissect Dr. Judy Shelton's insightful strategies for addressing the dollar crisis.
That's right. She argues for a critical shift back to sound money principles, especially gold-backed currency.
What's the core issue Dr. Shelton is tackling?
She stresses that our fiat currency system lacks the discipline needed for monetary stability, resulting in financial chaos.
That's a bold claim. What evidence does she provide for this?
She cites alarming debt growth from $400 billion in 1971 to nearly $36 trillion today, highlighting the urgent need for reform.
Dr. Shelton claims that central banks have become overly influential in financial markets. What implications does this have?
She believes this politicizes monetary policy, steering financial rewards unfairly while undermining economic stability.
Could soaring national debt pose an existential risk?
Absolutely. Dr. Shelton highlights that interest payments exceed defense spending, an alarming financial red flag.
What solutions does Shelton propose to counter rising debt?
She advocates for strict government spending cuts and a reevaluation of bureaucratic layers.
How does Shelton connect gold to sound money?
She argues gold provides a trustworthy, stable foundation, unlike fiat currencies that risk inflation.
With nations discussing alternatives to the dollar, what risks does this pose?
It undermines U.S. dominance in global finance, emphasizing the need for restoring trust in the dollar.
Shelton flirts with the idea of treasury bonds backed by gold. What does that entail?
It proposes a new financial instrument ensuring that purchasers can redeem bonds for gold or cash upon maturity.
What's the implication of Shelton's proposed reforms on policymaking?
It could lead to more accountable government spending, enhancing the potential for economic stability.
To wrap things up, what crucial insight should viewers take away from this discussion?
The importance of transitioning back to sound money practices, it's about securing financial stability for the future.
What a ride through the intense discussions about the US dollar, inflation, and the future of investments.
Absolutely. Dr. Judy Shelton raised the stakes with her call for a gold-backed dollar while critiquing our current fiscal path.
And let's not forget Lyn Alden's insights on focusing our investments towards 2025. It's all about anticipating shifts.
Exactly. But Luke Gromen makes a strong point when he claims that bonds are becoming uninvestable due to inflation concerns.
And with Paul Tudor Jones warning about the inevitable inflation from increasing government debt, it's clear we are in uncertain times.
For sure. So viewers, if you found this discussion valuable, be sure to like and subscribe to catch more insights like these.
Don't miss our next videos where we dive even deeper into financial trends and strategies. Keep an eye on your investments, everyone.